From Wall Street to Main Street to help small business owners have the same capital as corporate America and give them the same resources as a larger company. We cover business funding, business credit, scaling, business consulting, and much more. Check out the website at shieldadvisorygroup.com. Welcome to the show, The Liquid Lunch Project.
And we are live. Hey, everybody. Welcome back to another episode of the Liquid Lunch Project. I am Matthew R. Meehan alongside my partner, the Professor Luigi Rosabianca. What's on tap today, Lou?
Matt, today we've got a very interesting topic that you and I fortunately deal with on a daily basis, but I don't think the audience realizes the synergies of Main Street and Wall Street currently in America. Now, Matt, you're a lot smarter than I am, and you'll be able to tell us, along with our guest, Jordan Wagner, why this is so. But suddenly, mom and pops in America are the new darling for Wall Street. So Jordan Wagner is one of the founders and principals of the Exit Group. Jordan, welcome to the Liquid Lunch Project, and help us unpeel this onion on why Main Street is so attractive to Wall Street.
Yeah, well, first off, thank you guys for having me. I appreciate it. And you know what we've noticed over the last 12 years in terms of the boring businesses, we call them, the essential everyday kind of HVAC, plumbing, generic lawn care, things like that, is there's a lot of the Wall Street investors that are looking to buy those businesses, and at scale, they can create a lot of synergies. They're the word I use, essential. They're essential to the consumers and to their customers, and they really create great fundamental businesses.
So, Jordan, do you think maybe a little bit of this is macroeconomics and maybe a little bit of this is just cultural? I mean, I remember growing up, my dad's garage was filled with tools and trimmers and lawnmowers, and I mean, he was Mr. Handyman. I think the modern day garage probably has video games. Is that attributing a little bit of this largesse when it comes to the trades?
Yeah, well, I think that's true. You know, like the younger generation is willing to pay for a lot of services. Like the amount of subscriptions we all have is way more than the previous generation. They outsource most things, whether that's handyman or picking up their food and delivering food or every single item. So it's created a lot more services, and a lot more services that are sticky. I think 20, 30 years ago, people did not want to have that monthly bill. They were less willing to do that.
Now, are you also seeing a lot of these baby boomers kind of rolling up their sleeves and, I'm going to go buy a sailboat and then sail into the horizon?
Yeah, I think that's one of the big things that we see, is that there are some businesses where an owner has hired a management team and it can kind of run itself and they can step away. And that's a great solution for some people. But for most family run, founder owned businesses, the founder's been working 60, 80 hours a week forever, and they're 60 or 70 years old, and they're looking for a way out of that. And they haven't set the business up to run without them. So a solution a lot of times is, whether it's selling to a private equity firm or a strategic buyer, someone who has experience in the space, who, maybe there's a 6-month transition or a year transition, but they actually can exit there because they haven't set up the company to let themselves do that.
No, Joe, I was wondering, why is a landscaping firm attractive to a Wall Street analyst?
Yeah. So I think years ago, even when we started the company, the private equity firms were going after much bigger deals. So 100, 200 million of revenue, those types of companies. And there's not many, landscaping companies of that size. But over the years, what we've found is, as there's more and more competition for deals in private equity, the private equity firms have come down and with being willing to buy smaller and smaller businesses. And one of the things that allows them to do that is when there's a large market or a national market. So whether it's landscaping or HVAC or plumbing, those markets, it allows a private equity firm to buy a company maybe at 20 million or 30 million of revenue. That would be far too small for them previously, with the thesis that we can buy a company of this size in the next 5 states, right? And then sort of slowly create national scale, and the total investment will be large enough for our fund. So the market size and the fact that everybody right, to take plumbing, everybody needs the service. It allows them to start on smaller deals and build their way up rather than waiting for a $200-300 million revenue business to come to market.
I absolutely love this because you have private equity coming in. First of all, they're buying fragmented mom and pop industries that are out there, right? They're coming in, they're rolling them up, they're making them a bigger company for what they need. But what this really actually does is helps out smaller business owners out there that never had access or private equity never wanted to deal with. Because let's face it, 80% of a business owner's net worth is tied up in their business, which is generally in a liquid asset. And they don't have any exit plan usually. They say, I'm going to give it to my kids or I'm going to do this, but they can't really retire and do what they want after selling the business, because everything's still tied in there. So I think private equity coming into this space is extremely beneficial to small business owners across the country.
For sure. And it's also really improved valuations, right? Like if you think to a 15 million revenue business 20 years ago, they were probably selling to a local competitor or to a friend's business or maybe a young business owner who was going to take it over. But those deals were, we'll pay you over 7 years. And if the company didn't go well, that may not have happened. They weren't getting a big chunk of cash at close for the business that they've created. But with so many private equity firms coming down market, it's actually allowed a lower level of business to cash out for a pretty significant chunk.
So let's talk about that for a second. Multiples, right? Because a lot of people out there, you ask them, what do you think your business is worth? They say, well, my friend sold his business for X, so I think mine is worth X. We call them country club multiples, right? At the end of the day, there's a lot of misconceptions around that because people, I think, don't understand that there's a range in the multiple from where they are, from best in class all the way down. If they're owner independent, if you still got to work in your business every day, right? And your business can't go on without you, your multiple is going to be a lot lower, right? If you're bringing in sales and you have no systems and operations or processes in place. So what are some things that you think the business owners on this, listening to this podcast right now, can actually go out and do to set themselves up for success?
Yeah. And I'll answer a couple of the questions there. I use the plumbing example, so I'll stick to that. Multiples are tough because we've had service plumbing businesses trade for 5 or 6 times EBITDA. And then we've seen companies trade for 14 or 15 times EBITDA, right? And, you look at them, they have the same trucks, they got the same similar website. So what's the difference? The first thing is, and this really is applicable to a lot of businesses. The first thing is their private equity firms are going to value the service revenue much more than the new construction or the one-time project revenue. So if you have a lot of service revenue, that's going to drive it. The smaller ticket sizes as opposed to big jobs. You talked earlier about, whether or not there's a recession. We were talking before we started, they like that. If you have a leak in your house, you're probably going to get it fixed, whether it's recession or not. So there's an essential component to it. The growth is probably the biggest element to a multiple, because if you're growing 20%, a group looks at it, a private equity group looks at it, okay, if we pay a little more, a year from now, it's going to look better because EBITDA's up. So that's one of the biggest components. And then, as to your point, management team, how deep is the company? How's the sales and marketing? How does it run? All of those things. So you take 5, 6, 7 factors and the range is just so large. So, but to your point on country club multiples, if someone has 5 friends who sold their business, they're always quoting the highest one.
Always.
Yeah.
Doesn't it take into account who the buyer is though too, right? So private equity is known to make big buys and pay up a little bit more, especially if they're adding it on to one of their platform companies. But a strategic buyer will just buy the company because they want the assets or they want the market share. Can you explain that a little bit to the audience?
Yeah. And I would say when we started the business, we found that strategic buyers were paying more than the typical private equity buyer. And then in the last 5 years, it sort of flipped. And I think it changes over time just based on the period and the industry. But typically a private equity firm, if they're not in a space yet, the typical structure is they're going to want to buy, call it 60, 70, or 80% of a business allow the founder to roll over and own 20, 25%, something like that, but take a big chunk of their chips off the table to diversify their wealth, and then try to more aggressively grow the business with this new capital behind them over a 5-7 year period, and hopefully exit at that point. During that hold period, the private equity firms will also do a series of smaller acquisitions where they will buy a high majority or 100% of those businesses, and those multiples can vary. And then when we look at a strategic buyer, you have your public companies, other large corporations, or other private equity backed players who already have a management team, already have their systems in place, and they're really either buying customers, maybe buying a product line, or maybe buying a territory. So in the examples we've been talking about, which are more localized businesses, plumbing, HVAC, most of the acquisitions are I'm buying a territory. So I'm in California, I want to get into Texas or Nevada or Arizona, and that's what they're buying the company for.
Jordan, I know you gave certain examples just for the purpose of analogy, but what trends are you seeing today from private equity in Q3 of 24?
Yeah, right now, the essential services I mentioned, that's the biggest trend we're seeing. So I made the point, if you have a leak in your house, you are going to fix it, whether it's a recession or not, right? Nobody knows if a recession's coming, but there's election uncertainty. So a lot of groups are trying to focus on what they deem an essential service or a needed product, something that's needed for the business to operate, whether that's on the industrial side or whether that's on the consumer side, and trying to stay away from things that are tied to whether it's new home building, new construction, like remodeling your house. That's something it's a luxury to do, luxury products, things like that. And they're just trying to focus more on things that, we generally need during good times and bad.
Jordan, are you seeing any sort of geographic variable or multiple with these sort of trade businesses? Like, for example, if a business is in a hyper growth Nashville, Atlanta, or Austin, is there a certain X variable as opposed to maybe a more mature market like Cherry Hill, New Jersey?
Yeah, the states that are gaining population are more attractive to investors right now. So, for the last couple of years, it's been the Texas, Florida, like you said, Nashville. Most of those companies are trying to get into those markets, whereas some of the states that are losing population, they're just a little more hesitant. So it affects the multiple. It's hard to say exactly how much, but I would say it's significant.
Now, with these businesses, how much of a legacy stay on do you see with the principal? Or are these private equity firms just purchasing the business and, like I said earlier, the founder just retires?
Yeah, so I will start with the regular employees. When I came into the industry, I always heard the private equity firms kind of slash the team. What we've noticed over 100 and something deals is more times than not, 3 years later, there's a lot more employees at the company than less. So they're usually growing it. So most of the employees stay. And my sense is like being part of a company that's more aggressively growing. The founder or CEO is hit and miss. So we get a lot of founders who have already determined before the deal, they don't want to work for someone and they want to retire. That's probably 50%, and they leave within the first 6 months as was planned. Then you get founders who are on the fence and want to stay. And I would say that's hit and miss. You get some who love the fact that they have all this money off the table. They can be more aggressive with someone else's money, right? And grow the businesses. But you do get some founders who, like it's a wake up call. I never worked for anyone. I never want to work for anyone. And they end up leaving in a few years.
Jordan, on what you think the long-term strategy is for these private equity firms. I mean, are these long-term holds, or are they looking to bundle these over the next couple of years, and we're going to see some huge bundled sales? How's this going to work?
Yeah, so typically what the goal is for them is to build scale, improve operations, improve margins, and really improve, like we'll keep using the plumbing example. Like, how do you get better Google reviews? How do you get more customers? How can they integrate technology so that it's easier for you to pay the bill and it's not, you have to pay in cash, or, you're unclear what the invoice is. So they try to really put everyone on the same software, improve the efficiency of the company. And then eventually they're going to exit. For some groups, that's 5 years. Some it's 7 to 10, but I would say 4 to 10 years is kind of the hold period where they're going to eventually sell it, probably to a bigger private equity firm or go public.
Now, Jordan, Matt mentioned earlier, a lot of these firms were fragmented, and that's one of the reasons they're so attractive. Are you seeing any trends with the white collar trades, CPAs, law firms, bookkeeping, and any trends there?
Yeah, and that's more recent. So the last 5 years has been more the blue collar stuff. Last 12 months, we've been getting a lot of deal flow and closing some deals in the white collar services. So CPA firms, specialty tax firms, different types of outsourced legal services, things like that. And that's been a more recent trend, and one that we think is going to be pretty exciting for the next 4 or 5 years. Similarly, there's a lot of owners in that 50 to 70-year-old range. Those businesses, historically, the only option really was to sell to their partners, which is sometimes a comfortable sale. But the tough part is there's not a lot of cash up front. So it's a 7, 8, 9-year payoff. So now that the private equity world is sort of open to those businesses, which for a while they were not, it's opened up a lot of doors, and it's picked up very quickly.
Yeah. What are you seeing in the marketplace right now? Are you seeing a lot of competitiveness? Because everybody coming out of business school right now wants to be in private equity, where 15, 20 years ago, they wanted to work on Wall Street. You have these searchers and search funds popping up, right? It's the cool thing right now, right? Let's buy a business. It's cool. Are you seeing companies overpriced because of this? Or
I would say
not selling?
In terms of real offers, I find the level of clients we're dealing with are going to be a few tiers above, like the fund list search firms, where it's just tougher for them. They don't have the cash on hand. It's tougher for them to make an all cash offer or make an offer really quickly. So when it comes to the offer stage, I think the serious big time acquirers separate themselves pretty easily. Where there is trouble, though, is on the outreach. Because when you reach out to a business owner, sometimes it's just like, well, I got reached out to by 25 different people. I don't know who's who. And most of the time, if a business owner had someone in the industry to look through those, there's probably 4 that are, superior to the rest of the group, that are more realistic, real buyers. And if they happen to talk to the other ones first, they may just shut down the whole thing down, say, this whole industry is a bunch of BS. I'm not wasting my time. So we fight against that a lot on the front end.
Jordan, are you seeing any trends with like vets, dental, chiro?
Yeah, I would say all of those. We haven't spent as much time as a firm there, but the industry as a whole has. The veterinary clinics have been rolled up. There's a lot of big acquirers there. The dental has been a really big one. So there's been a huge push there. It'll be interesting to see how it plays out. Our firm actually hasn't spent a ton of time in those spaces, so we're not as close to it, but we've definitely seen it with a lot of our clients.
Where do you think? Am I crazy? Matt, am I crazy? I'm getting deja vu. Jordan and his firm, doesn't it remind you of the real estate prospectors of like 20, 30 years ago? Everybody was looking for like real estate deals and new developments and suburban sprawl. And I think the new bullseye is on the mom and pop small American business. Jordan, you're at the right place at the right time.
I hope so. Yeah, I think the biggest thing that people say, what's the barrier to entry of your industry? And the biggest thing is time, right? Like our first 3 years, we didn't close a deal. So as opposed to real estate deals, the deals take so long and the relationships take so long that it's a tougher space in that way. Just the amount of time that you're going to take and before a lead turns into a deal will typically be 2 or 3 years. So that part of it's different, but I think in terms of what you're saying there, I get the alignment.
So how do you guys go out and you find owners? I know it's mostly through relationships, but do you guys do a lot of marketing? And how do you guys find your clients?
So we do a lot of research. We have a research team, and some of it is, advanced technology wise. So, you have AI tools that could scrub Google and its keywords and trying to find things, but some of it is just so manual and we can't change that. So when we're looking for plumbing business, we literally have people going by zip code, most Google reviews, right? How many are there? And then we have a formula of how many Google reviews equals X amount of revenue. So we think this company's 10 or 15 million of revenue. But yeah, we've bought a lot of different advanced software tools that do help us. I don't want to overly criticize them, that help us find companies that are larger in their space. But it doesn't get rid of sort of that manual work of like, if I drive around and see 15 trucks of a company, that's probably a better sign of their size than the estimates the software gives us. And then from there, what we're trying to do is see from their website and any other publicly available info, like, do they check the boxes of the criteria we're looking for? Like, do they provide those services? Do they have the certifications that you need for whatever space it is, et cetera? And if they do, then we'll begin, outreach to them and explain who we are and why we're reaching out.
So tell me about a deal that you guys were working on that fell through in the 25th hour, because that happens a lot, doesn't it?
Yeah, that should be fun to talk about. I'll give you one that is probably the worst one, and not just the situation, but also, the time of our careers. So we started the business in 2013, 2012, 2013, and we had not closed the deal in our first year. We had come close a bunch of times, but it's just, things just don't always go your way. And then year 2 or 3, I can't remember exactly, we were working on a really large deal. I think the purchase price was 300 and something million, 350 million, let's call it. And that was a big deal then. It's still a huge deal for us today. So at that time, it could have been our first deal. The LOI gets signed. It goes all the way to purchase agreement. And the night before close, the owner walks from the deal. And I remember going to the office. There was 3 of us that worked in this small little office here in Vegas. It was so depressing, but also not just the fact that you thought you're about to have all this money and kind of hit the ground running, but because deals take so long, you look at your pipeline, you're like, not only did this not go, nothing else is going to go in the next 6 months at least, because it'd be under LOI already. So that. So you're like staring down a long tunnel there. So that was definitely the worst one.
Wow. So what are some things that you guys put in place to make sure that doesn't happen moving forward with some of these potential sellers that you're bringing to the table?
So I wish I had a good answer for you, but I think the real answer is we try to have enough going on at all times that we can afford for it to happen, because these deals are so complex. Every year it happens. You hope it's not the biggest ones, but every year, and it doesn't need to be, anyone's fault or a huge reason. Sometimes someone in someone's family passes away. Sometimes company gets hit with a lawsuit mid-diligence. They're going to get audited and you have to wait for that to finish. So there's some sort of outside things that nobody can control that happen. And, I still, as we hire new people, when it happens on their deal for the first time, you could see that same disappointment and it feels like a little bit unfair. But I think the best solution for us is just sort of expect it, 4 or 5 times a year it's going to happen, and just have enough going that we can afford for it to happen.
Yeah. You know what I've seen? You're on the buy side, so you're working with the acquirers, right? Yep. I see a lot of times when a business owner thinks that the deal's done, they get a little comfortable. They start getting a little sloppy in the business. They're not showing up all the time. And when the acquirer on your side says, you know what, it's just not working, it's not going to go through, they're stuck between a rock and a hard place, because the business actually took a little bit of a downturn and their mind was already them on a catamaran in Aruba, right? Yep. And they kind of get in a little bit of trouble, right? How many times and how many deals? I know you guys have done over 100 deals. How many times have you had your side walk away from the table, would you say?
So I would say probably 20, 25 over the last, probably 2-3 a year. And I'm talking post LOI, so they've agreed on it. And a lot of times it's to your point, whether it was because the CEO took their foot off the gas or not. When they're getting a big price, the bigger the price you're getting for your business, the more pressure that's in diligence. Like the more they're paying a premium, the more you need to perform those 2-3 months. And so sometimes a company's growing 20-30% and says they deserve this premium valuation because of the fast growth. Well, if in those 60 or 90 days of diligence, there's a month or two period where it looks like it's slowing down, most acquirers get a little nervous. They make you prove it out one more month. And if that goes bad, the deal kind of sours. So sort of the bigger the price they pay, we find the more pressure that's on that diligence process. And, people can definitely get nervous and walk away. We've had business owners sign an LOI and say, we're coming to Vegas. We want to do a celebration dinner. And we're always like, there's nothing to celebrate yet. Like the LOI, it doesn't mean much. Like you need to make sure the deal closes.
Hey, Jordan, besides the natural financial disclosures, what do you see from a due diligence perspective from the private equity side? Are they conducting site visits? Are they contacting vendors and clients? Like how deep are these private equity firms going?
Very deep. We tell business owners that prepare for a colonoscopy, and most of them say it's worse than we said, but they're going to do a quality of earnings, have a third-party accounting firm come out. That part's not too complicated. If you have a facility or a manufacturing facility, they have to send people out and do environmental diligence, but then they're going to go through every one of your financials kind of with a fine-tooth comb and say, okay, look at every customer over the last 5 years. What's the up and downs there? Are there any trends? Are there any customers that are related in some way that they're really grouped together? Like they look at it from so many different angles just to make sure they're not making a mistake. And I think one of the challenging parts for business owners is it kind of comes across to them like, hey, do you not trust me? Like, I sent you all my numbers. I've given you everything. And you're kind of asking me the same question again. And it's really just coming from the private equity firms are investing, other people's money. They have to watch the risk and the downside and be overly cautious. But it's definitely a painful process. And it's probably the hardest part of our deals to get through.
So when that does happen, right, what would you say the average time frame from start to finish is on some of these deals?
So from signed LOI to close, our average is about 60 to 70 days. But that's probably downplaying it a little bit because there's a lot of time before the LOI is signed too. So, like for instance, we'll talk to someone, they'll say, I'm not ready yet. I want to grow, but call me every quarter. And that goes on for 2 or 3 years. Then they're ready to do something. We introduce them to our client. There's probably a month of exchanging financials back and forth to get to an offer. And then once the offer's signed, then it's the 60, 70 days. So although that last piece is pretty condensed and it's sort of working hard every day to close the deal, sometimes it feels a bit longer to owners, especially if, it took 2 weeks for the group to visit and come see them, like all of a sudden feels like you've been working on it all year.
Yeah. So when I worked on Wall Street, we brought a lot of companies public, right? In order to get a company set up to go public would take 3 years, about 36 months. And that's on the low side, right? Because you have to come in, you got to financially re-engineer the company because now we start caring about losses because we're going public and venture money is going to be out soon, right? So essentially you start to re-engineer the company, right? Then that'll probably take 12 to 18 months. The other 18 months is spending time finding the groups that you want to work with, the advisors that you need around, making sure your operations and your processes are up and running, right? And then it's regulation, right? So my point is, from the time you think about going public to actually selling into the market is about 3 years. Now, you said that you start talking to people about 2 years prior to their sell, right? How crucial is it that these companies start getting their financials in order prior to actually selling or looking for an offer?
Yeah, I would say it would be very helpful. More than half of them don't do anything in those 2 years. So we have a conversation, they talk every 6 months and they never do anything, and it makes diligence more painful. I think it's smart when owners, because we've seen others who move from QuickBooks to a more advanced system and have a CFO in place to make sure they can handle all the requests. And I think it makes life a lot easier, not just while they're running the business, but then also when they do a deal. You'd be shocked at some of the size deals you can do in the private equity world where they're on QuickBooks and there's no CFO and you got to work through it, but it's a lot more painful.
Yeah, I'm sure. I'm also sure if they do have their T's crossed and their I's dotted, the deals close a lot faster and
completely. They close a lot faster. There's a lot less issues, right? Like one of the problems when it's not super organized is that's just when surprises come up, whether that's company's more profitable than you thought, less profitable than you thought, has an issue you weren't aware of. And then that's when now the offer changes. How do they feel about that? So it's a lot smoother when things are organized.
You know, everybody's talking about the baby boomer still, the silver tsunami that's coming around. But I think what most people aren't realizing is a lot of people my age, I'm 43, so I'm a Gen Xer right now, are taking over these businesses, but they're actually trying to grow the enterprise value of the business to sell it, right? So I think your business is in an uptrend. And I think as we progress forward, you're going to get a lot more deals thrown at you because a lot of people are trying to build their businesses to sell at some point. Where
for sure,
the baby
and I would
boomers
say
really didn't have a legacy play in place.
For sure, and I would say to that point, there's people who are building them just to sell them, but I think the most impressive and most successful people we've seen are building them to build them to make a better business, right? And they're kind of like, how can we make the best business for the customer? How can we get better at this? How can we make people want us? And the beauty of that is they're actually end up being the more attractive businesses to sell also, right?
Yeah.
Like, because they've built it long term. Some people we see who go in there with like a 2-3 year mindset, it's sort of too quick to make good decisions long term for the customers. And they're trying to financially engineer their way, use SEO to drive some customers and build, but it's a quick flip sort of model. Sort of like flippers and houses where you like, if you pull up the wood, it's not really that good underneath. But yeah, I think the most impressive people we've seen who have, done it themselves, bootstrap, try to buy a small business and build it up, is they're really just building, like they're treating it. What would I do if I was going to hold it forever? And then maybe they could still sell it, but that's how they're operating.
Yeah. I think we refer to them as lifestyle business owners and value creators, right? Somebody's actually creating value. The other person's just eating out of the business, and whatever comes in that month they're trying to pay as least in taxes as possible. And then one day they want to sell it and they realize, well, I didn't do anything right. So there's not really much value here. So I think that's very important to start educating business owners on that if they want to exit one day.
Absolutely. I think that's the biggest thing we've learned from, the business owners who have sold for 500 million or whatever. They were no different than the smaller business owners, but they were focused on just every decision was the long-term, what's best for the customer, what's best for my team, rather than, what will make me worth 20% more next year.
One question we didn't ask you: how did you get involved in exit planning or exit strategy or helping businesses exit? When you started the firm in 2013, what was prior?
Yeah, so I was a major in accounting in college. I had an internship at a company that's pretty similar to what I'm doing now. Like last couple of years of college, I was the first or second employee. There was only 2 or 3 people there, and I loved it right away. It was interesting to me. So as soon as I graduated, I took a job there. Over time, there was a few other employees there, and we moved to Los Angeles. And then after a couple of years, me and a couple of the guys thought we could go off and do it on our own and left. We convinced my dad to invest some money in us. We lived at my parents' house here in Vegas for a couple of years. And yeah, it was a slow start, definitely some time in the middle there that it was not looking good. But I would say year 4, 5 is when things started really to turn for us.
That's awesome. I love those stories. So why don't you tell the audience where they could find you, get in touch with you if they have any questions, or the exit group?
Yeah, for sure. My Instagram is just Jordan Wagner, no spaces or anything. And our website is just exitgroup.com. And we're going to be putting on more educational videos for business owners just on different scenarios, how to make their companies, receive a higher multiple, what industries the private equity firms are going after and things like that.
Jordan, thank you so much for being here. We really appreciate you. I have one question before we let you run. If you had to go into one industry right now, what would it be?
That's a great question. Lately we've been seeing a lot of movement, and I'll just give one example of a business in the property management space. And part of the reason is, to one of your points earlier, was on this new generation doing less. A lot of people, they'll buy a second home or move, and they don't want to do the work, which is not that much work, of collecting the rent, fixing problems when they come up. So there you go. So they'll sub it out. And as I was looking at the financials, this is the new one the last couple months. You really at the scale, those are really, really good businesses. It's recurring. You sort of get price raises naturally because you're getting a percentage and the rents go up over time. So that was definitely one that's piqued my interest and again, it's one of the businesses you could actually do, right? I love businesses that I can understand, that are simple and that seem realistic to get into, as opposed to, I'm not going to start the next Facebook, right? So that's one of the ones that I think is really interesting right now.
It's so funny because I actually hired a property manager. And the other funny part was I have one property that I manage, I guess, and I had to go find somebody for the AC unit. So you know how many AC people I had to call off Google before somebody answered their phone? It's like they're living in the Stone Age. So many people. Everybody, that's a wrap on the Liquid Launch Project.
Thank you for listening to the show. And make sure you subscribe, leave a review, and share it with a friend. We'll see you on the next episode of the Liquid Launch Project.